On Thursday, March 19th, Dalal Street absorbed a massive wave of selling. The Sensex plunged nearly 2,500 points in a single session, while the Nifty fell over 3%, closing precariously near the 23,000 mark. Three distinct catalysts caused this panic. First, escalating geopolitical tensions in the Middle East pushed crude oil prices straight past the $100 per barrel threshold. Second, domestic market sentiment took a severe hit from inside the corporate sector, following the sudden resignation of HDFC Bank's part-time chairman. Finally, the U.S. Federal Reserve adopted a highly hawkish monetary stance, putting downward pressure on global equities. A hawkish stance refers to a central bank prioritizing the control of inflation, usually by keeping interest rates high. The simultaneous pressure from expensive oil, domestic banking instability, and high U.S. interest rates created a synchronized macro shock that erased days of gains. Every portfolio now requires an immediate, calculated reevaluation. The immediate drop in stock prices is visible, but the mid-March macroeconomic data reveals a secondary, longer-term threat brewing beneath the surface. Look at this dual-line graph tracking inflation over the last 12 months. The pulsing top line shows February retail inflation hitting a 10-month high of 3.2%. Retail inflation, or CPI, is a metric that tracks the change in prices paid by everyday consumers for a specific basket of goods. The main culprit driving this number up right now is stubborn, sticky food prices. We see the exact same upper trajectory with wholesale inflation, which tracks the price changes of goods before they reach the retail level. That rate just hit its own 11-month high of 2.13%. Now factor in that $100 crude oil spike from the Middle East. Higher imported fuel costs will inevitably bleed into both consumer and wholesale prices, pushing these lines even higher next month. When food stays expensive and fuel prices surge, the Reserve Bank of India has very little room to maneuver. This combination makes it highly likely they will delay the interest rate cuts that investors were heavily banking on. While traders watch the red tickers, two underreported regulatory updates from this week pose a much more immediate administrative risk to your capital. First, the Reserve Bank of India announced a 75,000 crore rupee variable rate repo auction for March 20th. A variable rate repo, or VRR, auction is a mechanism the central bank uses to inject short-term funds into commercial banks. The RBI is deploying this massive emergency liquidity because the banking system is incredibly tight as institutions scramble to balance their books before the financial year ends. The second major update comes from SEBI. On March 17th, they released a proposal that directly targets the structure of personal demat and mutual fund accounts. SEBI plans to make account nomination the absolute default. If you do not want to name a nominee for your investments, you will be required to submit a formal, specific declaration to opt out. They are implementing this strict rule to neutralize a growing systemic danger, the massive pool of unclaimed assets sitting in dormant accounts after investors pass away without clear beneficiaries. Market volatility will come and go, but failing to navigate these strict new SEBI compliance rules and the tight liquidity environment before the fiscal year closes is a guaranteed way to freeze your assets. Let's bring this back to Dalal Street. A 2,500-point drop looks terrifying on the surface, but treating it purely as a negative event ignores the math behind the valuations. This candlestick chart shows the Nifty 50's descent, approaching a glowing line at the 22,900 mark. Zooming out over the last 11 months, you'll see 22,900 isn't a freefall zone. It's a historical floor, an established zone of structural support. Surviving a macroeconomic dip like this requires a strategy known as sector rotation. Sector rotation is the practice of moving capital out of industries that are struggling in the current environment and into industries that are positioned to benefit. Right now, the danger zone includes aviation, logistics, and FMCG. Because these businesses rely heavily on transportation, they are mathematically vulnerable to that $100 crude oil shock we discussed earlier. Contrast that vulnerability with areas showing real institutional resilience. Even during this week's panic, large-scale capital continues to flow into the infrastructure space. We saw proof of this with the Rajmarg Infra Investment Trust filing papers for a new public issue. An INVIT, or Infrastructure Investment Trust, is a mutual fund-like vehicle that allows direct investment into revenue-generating infrastructure projects. Institutional money is targeting these assets because roads and power grids offer reliable returns, regardless of equity market volatility. We are also seeing movement in corporate yield plays. The Vedanta board is meeting on March 23rd to consider a third interim dividend, providing a highly defensive income generation opportunity. The trade-off is straightforward. To secure these deeply discounted infrastructure and dividend assets, you must be willing to endure severe short-term volatility in your overall portfolio value. While the broader market remains in a period of intense volatility, these specific flows into infrastructure and dividends represent a targeted rotation of capital away from high fuel cost dependencies and toward more resilient, high-yield assets. This decision tree shows how your next move depends on your role. The correct action requires knowing which threat applies to you. If you are a consultant or advisor, your primary battlefield right now is not stock valuation. It is an immediate administrative audit. You need to contact your clients today and secure their formal SEBI nomination declarations. Getting this compliance locked in before the fiscal year end is the only way to prevent their assets from being frozen. If you are an active trader, your primary threat is the geopolitical oil squeeze. Your focus shifts entirely to aggressive sector rebalancing. You must audit your exposure to those high fuel cost sectors immediately. Rotate the capital out of logistics and aviation to avoid margin compression. Margin compression happens when the costs to run a business rise faster than the prices they can charge, completely shrinking their profits. For both advisors and traders, sitting on your hands this week is an active risk. Survival means executing these specific changes right now. Finally, we turn to the largest group, the long-term retail investor. Do not make the mistake of panic selling fundamentally strong assets just because crude oil spiked in the Persian Gulf. Instead, view the Nifty's approach to that 22,900 level for exactly what it is, a rare accumulation zone. The math supports buying the dip here. Focus the capital you accumulate on the resilient sectors. Look closely at infrastructure invites and reliable dividend pairs like Vedanta. And remember, long-term holding does not exempt you from compliance. Check your DMAT account today and confirm your nominee status to satisfy SEBI rules. Extreme volatility is the permanent price of admission in emerging markets. The investors who end this financial year in the strongest position will be the ones who ignore the media panic, secure their administrative compliance, and use the structural discount to their advantage.